Hello and welcome into today's video. Today I'm going to be going over some book recommendations, essentially my top 3 investing books plus a bonus for a runner-up that didn't quite make the list. So I'm going to get into it and we'll start with my sort of favourite book. And I will just caveat this by saying that I think a lot of these books really depend on your strengths and weaknesses. So what I've tried to do is selectively work on my weaknesses as we've gone. And for this reason, one of my favourite books is actually this book here, Quality of Earnings. And the reason that this is my favourite book is because it's allowed me to sort of better interpret the financials a company has. So without spoiling too much of it, it gives you like 4, 5, 6 key methods that you can use to then sort of look for red flags. And this has actually been very useful in some of the ideas that I've been looking at where I've, for example, had a company where I've seen that their revenue had been growing modestly, a couple percentage points here and there. And then actually what I noticed is that their account receivables jumped massively as a percentage versus their cash having dropped. Long story short, what this meant is that the company, either two scenarios realistically were happening here. The company was offering massive sort of credit discounts to its consumers, sort of attractive credit terms to try and get in as many customers as they can in the short term, which shows weakened supply, or their customers en masse were sort of struggling financially, which also has negative implications here. So either way, it was sort of a lose-lose scenario here. And, literally it made me sort of hold off on that and just sort of reassess further sort of the short-term financials there. And literally within a few weeks later, the company had announced that a profit warning, that their profit was about to drop 80 or so percent for the next year anyway. Now, of course, that's not to say there's an issue with the company long term, but it does allow you to sort of see if the company is sort of trying to scale its numbers where it's unrealistic. This could be particularly common with sort of growth stocks, and whether you're trying to assess whether it's sustainable or not, and that can often be a good measure. So highly recommend. This has sort of helped me out a lot. But again, I think what you'll notice with these books is that the ones which you have the biggest sort of weakness in or least sort of strength in, that's where you'll find it the most beneficial. That's been my experience here. So this book is Joel Greenblatt's book. Still got the sticker on there, that's pretty funny. And essentially what it talks about in here is the various different sort of methods that he uses in his sort of investing toolkit. Whether that sort of means, spin-offs, and any sort of arbitrage opportunities and so forth, but he really gets into the detail as well. So even though you might be experienced, there's still a couple of things that you can pick up there for sure. For example, one of the things that I didn't realize is that during a spin-off, usually what happens is that the company which gets spun off, shares usually within the first year drop massively because everyone is usually holding the stock for the main company which hasn't been spun off. And then that's somewhat to be expected that the stock's going to then drop for the year after. But another thing I didn't realise is that these share incentives usually only kick in about a year later. And actually, a lot of these spin-offs will have massive opportunity after about a year where it's sort of had this bottoming out process and the incentives start to kick in from management. And you usually want to, and Joel emphasizes sort of the management's incentives and what have they got in place. Are they truly aligned? Do they have skin in the game? And so forth. There are a few other tips and tricks, but again, I don't want to go spoiling the book. For those of you who don't know who Joel Greenblatt is, he's again one of Buffett's sort of disciples. He's gone on to do very, very well for himself, having sort of made at some point with smaller, well, I say smaller, but for what he would call smaller sums of capital, he has annualized 50% a year return with him and his partner, investing partner. for that period of time, which is just phenomenal. I mean, that's, if you can sort of get, I think, around that range, you're sort of making about 60x plus within the 10 years, which is just incredible. So moving on, my third book is The Great Depression, A Diary, and it's sort of what's in the name of this book, but essentially, or it's what you get on the tin really. Essentially, it goes through someone's reports as living in the sort of Great Depression, but also observing the financial markets. Now, they obviously adjust this book for sort of talk about more about the financial markets. And what I found really interesting is sort of people's take on investing and how it's so different nowadays. But what I really see this more as is like a pill where everything, if the market is sort of roaring, everything's going up, the indexes are going up 20% year on year, like they have in 2023 and 2024. Perhaps reading this book will sort of ground you more in reality and sort of help you keep level-headed. You have one side, you have the markets raising 20% a year, and then the next side you sort of have this book talking about, well, hold on, it wasn't so long ago, it was only 90 years ago or so, where people were demolishing houses so they wouldn't have to pay the tax on the houses. They wouldn't have to pay taxes associated with the house, and it just made more sense to own the land. And even house prices had collapsed to a fraction of their previous value. So of course that's one extreme to another, but it sort of helps you keep more cool-headed, but it also helps emphasize that saving and being prepared for the right situation is always going to sort of help you, whether that means that there is no crash or there is, you're still going to be in a good position, and that's something that's really important. It keeps you level-headed, and which I think is invaluable as an investor. And so that's the three sort of top books I recommend. Again, you probably want to notice that each book has sort of a somewhat different element to it, and you may find it more useful at other times than sort of currently. Last book I sort of wanted to go over was Principles from Ray Dalio. Here we go, we got it the right way up. Principles from Ray Dalio, and essentially this book covers sort of his philosophy, but also sort of related to financial markets. One of the two key points that I found from this book was, firstly, the sort of economic cycles of markets. Now, as a value investor, I don't necessarily look at the macro as too often, because it's not something that my little brain can handle, and nor is it too relevant. But I do think that there is benefit in knowing that the historic cycle of sort of countries and nations as how they sort of rise and fall, and it's, in essence, what happens a lot of the time is that you'll have the upcoming power that's challenging the dominant power at the time, and then what they'll do is the sort of rising power will sort of copy and steal their technology, shamelessly clone it, as Monish Pabrai likes to say, use it for themselves, and then sort of outpace them in growth, but another outpace them, whether that be in GDP, or whether that be any other elements, or have better technology. But so that's sort of the first element, which is they sort of clone their technology, that I found really interesting. But the second thing which I found really interesting as well is that actually a lot of the powers which were the dominant power at the time fall because they take on too much debt that their country can then not recover from. That's sort of, you've seen that with the likes of Japan, with the likes of the US. Of course, the US hasn't fallen, but I mean, if you've looked at how much debt they put on their balance sheet since COVID, it's been immense. Now, that's not to say the US is necessarily going to fall anytime soon, but I do think that just reading that gives you a good understanding of sort of the market cycles, and sort of the cycles of different powers within the world. And the second part is sort of a principle, which is sort of, you have first order thinking, second order thinking, and then third order thinking, which means what I found really useful about that is that most people, including myself, normally only think about the direct consequences. So you know that working out is going to suck, and you're going to, for example, I don't know, let's say working out is going to suck and it's going to cause a lot of pain, a lot of inconvenience as the first order consequence, and you're not really going to see any much reward for it. But then second order consequences, like, well, what happens after that? Well, after that, you sort of might see, and then let's say, you know, a year down the road, let's say, the first order consequence of that might be that you're in shape. But then the second order consequence of that might be that, you know, you might be able to attract a better partner, or you might be able to um, enter into competitions that you weren't previously able to enter, whether that just be you can now get to do different social activities. That could just be going to a run club, or that could be going football because to the local football team. Not to say that you couldn't if you were unathletic or out of shape necessarily, but it's something you're more likely to do. It's a sort of second order consequence. And then a third order consequence might be that you've now got a new friend group off the back of that, or that you've got a new hobby that you enjoy, which has then sort of led you into a different passion that you've now found that you didn't realize you had. But what I'm trying to say is that most people don't sort of, myself included, don't sort of take into account the first order, second order, and third order consequences and how everything has an impact. For example, you might see this being applicable in a better example, actually, is sort of like if you look at commodity companies. So what will happen is in these commodity players is that they'll go through sort of a boom phase where everything is really profitable, commodity prices are really high, so everyone increases production at the same time. So if you're just thinking first order there, you'd think, well, great, everyone's going to make more money. They're going to be selling more at higher profitable prices. But then if you look at the second order consequence, you'd see, well, this isn't going to be sustainable because supply is going to massively outweigh demand. Assuming this happens. And then third order consequences might be, well, now everyone's going to have, not only is everyone sort of going to benefit short term, yes, but then everyone's going to have taken out loans for assets at the same time to sort of buy them, whether that sort of be oil tankers or office buildings and so forth. So then later everyone's going to be trying to dispose of those assets at the exact same time when they become unprofitable, because there's too many people buying them at once and there's too much demand. Too much supply. So then you sort of have this lopsided cycle where you're doing really well for a couple of years, and then a couple of years you could be losing and doing, you know, significant damage to your balance sheet. So that's sort of the essence here, of what I've learned from these books. Obviously there's more detail, I don't want to spoil it all, but for me, I've noticed that if I have specific target areas that I might want to focus, I feel that selectively finding books for that has been very helpful for me. Thanks for listening. I hope you found some sort of value from this as well. Please let me know if you did. Thank you.